Per special request, this video blog is being prepared through the lens of F.A.S.T graphs, the fundamental analyzer software tool on 3M Corporation and Emerson Electric. Our first example is going to look at 3M Corporation for the period 1992 to current. We're going to plot earnings only here. The orange line represents the orange earnings justified valuation line, and this is simply a plotting of 3M. As you can see, 3M has grown earnings at 8.1% per year on average since calendar year 1992. For most companies, this line would represent the line that the stock price would correlate to. However, with a company like 3M Corporation, we're going to soon show here that the dividend becomes an important component of valuation. In order to illustrate that, we're going to add the dividend and the price line, and then finally the normal price earnings ratio to this graph. Now what you see here is that we have the same orange earnings justified valuation line that represents a PE ratio of 15 times earnings, but now we've added the blue normal price earnings ratio line, which actually for this example represents 19.8 times earnings. But what we want you to notice is that the light blue shaded area here shows the amount of dividends that are paid out of the green earnings area, or dark green shaded area. And what you'll see here is that historically the market has tended to price, the black line are monthly closing stock prices, the market has tended to price 3M at a premium to its earnings growth and more closely aligned with its dividends. And of course all this changed with the recession of 2008, when, like most stocks, industrials or otherwise, 3M stock price fell precipitously to the point where it actually fell below its earnings justified valuation line. In order to provide more detail, we're going to shorten this graph to a 15-year graph so that we can look more closely at what's been going on in recent years. You'll notice in calendar year 2009, 3M Corporation did see about a 10% drop in earnings from $5.23 to $4.73. Of course, this precipitated a very significant drop in stock price, where it fell from a high of $93.58 on September 28th all the way down to $45 by February 27th. And then of course earnings recovered as we've come out of the recession, and the stock price has recovered also. It's also important to note that this fully valued price, in line with its dividends in the beginning of this period, or the early 1997, and then the stock price touching the orange earnings justified valuation line, or in other words, we went from approximately a 20 multiple in the beginning period down to a 15 multiple towards the end of the period here. So when we look at the performance associated with this 15-year period, we see that a $100,000 investment would have grown to $212,000. That's approximately a 5.3% closing annualized rate of return. Plus we had $51,000 in dividends. We want to point out that 3M increased their dividend every year during this time frame, right up to and through the recession. However, during the recessionary period, you'll notice that the growth rate of their dividend did slow down. Their payout ratio has been consistently in the 30s and high 30 to 40% range since calendar year 2004. But the total return on 3M since calendar year 1997 has been 6.9% per annum. The current consensus of leading analysts following reporting to First Call and following 3M expect it to grow earnings at 14% a year going forward. That's faster than they've historically grown them. However, keep in mind that's during the recessionary years. So on that basis, looking at our value corridor here, which are these orange lines, 3M is what we like to say crawling the line, and appears to be very attractively priced with a PE ratio of 14.5 and an expected earnings growth rate of 14%. If 3M were to grow at this rate and trade at a normal 15 multiple, it would be a $178 stock by 12/31. However, if it would trade more in line with its historical multiple of between 19 and 20 times earnings, you could see 3M trading at $231.86 by year-end 2016. Now we're going to move on to our second example and compare a 20-year chart on Emerson Electric. And very similar to what we saw with 3M Corporation, we want you to notice that this company has tended to be priced historically by the markets more in line with its dividend, with its earnings growth plus dividend. In other words, what we're really saying here is that the market has applied a premium to earnings, giving credit for the dividends that the company has paid. It currently trades at 15.9 times earnings, has a dividend yield of 2.7%. If we look at the 20-year track record associated with this graph, we see that the earnings growth rate of 8% has generated about a 6.9% compounded rate of return. But like 3M, Emerson Electric is another company that has a very excellent dividend record. You can see they've increased their dividend every year since calendar year 1992. Like we did with 3M Corporation, we're going to go ahead and shorten this down to 15 years because we skip data on the 20-year charts because there's not enough room to type in all the numbers. So we're going to reduce this now to a 15-year chart so that we can see what happened during the recession of 2008 and 2009. You can see that 3M was trading at its normal price earnings ratio coming into the recession. Earnings hiccup happened where their earnings fell from 318 to 254. That was a 20% drop. There was a strong reaction with their stock price as the price actually fell, not only below their normal price earnings ratio, but significantly below their justified valuation based on earnings. And then, of course, once they've begun to recover, as they have here in recent times, you can see that the stock price has risen from the low of 26 and currently trades at 50, but it did get back up to its normal PE of 60 in April. Currently, the stock trades at 15.9 times earnings, offers a 2.7% dividend yield, and based on the consensus of leading analysts reporting to First Call, they expect Emerson to grow at 15% going forward, which means that at the current valuation, Emerson Electric appears to be very fairly valued, right in the middle of our valuation corridor. If they were to achieve this earnings estimate and the stock traded at a normal PEG ratio PE of 15, by 12/31/2016 it would be a $105 stock. If it traded at its more historical normal price earnings ratio, which has averaged approximately 20 times earnings, as you can see here to the side of the chart, it would trade something north of $147, assuming that it meets those targets. If we create a simple portfolio review here on Emerson Electric and 3M, we discover that both of these companies have good long-term histories and excellent prospects going forward based on current undervaluation. So to summarize these two examples here, Emerson Electric has a current PE of 15.9. Its normal PE has been closer to 20. Its estimated total annual return is 17.2% per annum, based on a consensus of 15% EPS earnings growth. It offers a 2.7% dividend yield at today's value. 3M Corporation has a current PE of 14.5. Its historical normal PE has been 20. It has a 5-year estimated total return of 16.2% based on a 14% consensus estimate of earnings growth. And it offers a dividend yield of 2.5%. This has been a video blog review of Emerson Electric and 3M Corporation. This review has been presented through the lens of the Earnings and Price Correlated Fast Graphs research tool.